Japan should probably be in crisis. Its economy has barely grown in over 30 years. Its population is shrinking faster than almost any major country on Earth. Its debt burden is now larger than the economies of many nations combined. And yet somehow, it still works. The trains still arrive on time. The streets are still safe. The shelves are still full. And despite decades of warnings that the Japanese economy was on the verge of collapse, the collapse never came. In fact, in many ways, Japan still looks remarkably stable compared to much of the developed world. Now, at first glance, this makes absolutely no sense. Because according to most economic theory, Japan should have already hit the wall. Its debt-to-GDP ratio exceeds 260%. That is the highest in the developed world. Its workforce is shrinking every single year. Its population is aging so rapidly that adult diapers now outsell baby diapers. Its stock market spent decades stagnating. Its wages barely moved for years. Its consumers stopped spending. Its growth disappeared. And yet, the country never imploded. No sovereign debt crisis, no hyperinflation, no mass unemployment, no societal breakdown. Instead, Japan entered something much stranger, a kind of economic suspended animation. An economy that by all traditional metrics should be dead, but somehow continues functioning. Which raises a much bigger question. What if Japan is not an exception? What if it is simply the first major country to enter the economic future that much of the developed world is slowly drifting toward? Because suddenly, countries across Europe, North America, and East Asia are starting to experience many of the same symptoms Japan has been dealing with for decades. Aging populations, falling birth rates, stagnating productivity, massive debt, asset bubbles, weak wage growth, and central banks trapped in endless stimulus. The truly unsettling possibility is that Japan may not be broken. It may just be early. So, what actually happened to Japan? Why didn't its economy collapse under the weight of debt and demographic decline? How did the Bank of Japan effectively rewrite the rules of modern capitalism just to keep the system alive? And perhaps most importantly, what happens if the rest of the world is slowly becoming Japan too? To understand why Japan still hasn't collapsed, we first need to understand just how extraordinary its rise originally was. Because for a while, Japan looked unstoppable. Following the Second World War, the country was devastated. Its cities were destroyed, its industrial base was shattered, and its economy was in ruins. But over the following decades, Japan engineered one of the greatest economic recoveries in modern history. Factories returned, exports exploded, manufacturing became world-class. Japanese companies like Toyota, Sony, Panasonic, Honda, Toshiba, and Nintendo became global giants. By the 1980s, Japan wasn't just successful, it terrified the West. American politicians openly feared that Japan would economically dominate the United States. Books were written predicting the Japanese century, and honestly, it did not seem impossible. Japan's companies were buying American real estate. Japanese electronics dominated global markets. Its trade surpluses soared. At one point, the land underneath Tokyo's Imperial Palace was supposedly worth more than all the real estate in California. That sounds absurd today, but at the time, people genuinely believed Japanese growth would continue forever. And that belief created the bubble. During the late 1980s, Japan entered one of the largest asset bubbles in human history. Stocks surged. Real estate exploded. Banks flooded the economy with easy credit. The Nikkei stock index nearly quadrupled in under a decade. Property prices became detached from reality. Everyone believed the same thing. Japanese land prices could only go up. Sound familiar? But bubbles only work while confidence survives. And eventually, confidence breaks. In the early 1990s, Japan's central bank raised interest rates to cool speculation. The result was catastrophic. Asset prices collapsed, stock markets crashed, real estate imploded. And suddenly, enormous parts of the Japanese economy were effectively insolvent. Banks had made loans backed by massively inflated collateral. Corporations had borrowed heavily, assuming endless growth. Households saw wealth evaporate almost overnight. Normally, this is where capitalism performs its brutal reset. Weak companies fail, bad debt gets cleared, banks collapse, assets get repriced. Painful, but necessary. Japan chose a different path. Instead of allowing widespread collapse, Japan tried to preserve stability. Banks were supported, corporations were protected, interest rates were slashed, government spending increased. And this prevented immediate disaster, but it also created something economists would later call the zombie economy. A zombie company is a business that technically survives, but barely. It earns just enough money to pay interest on its debts, but not enough to truly grow, innovate, or become productive. In a normal economy, many of these companies would fail. Their assets would be sold, their workers would move elsewhere. Japan prevented that process. Banks continued extending cheap credit to struggling firms because allowing mass bankruptcies could destabilize the financial system. The government tolerated weak productivity in exchange for social stability. And for a while, this actually worked surprisingly well. Japan avoided the kind of social collapse many feared. Unemployment remained relatively low. Crime stayed minimal. The country remained orderly. But there was a trade-off. Growth disappeared. The Japanese economy entered what became known as the lost decades. From the early 1990s onward, Japan experienced long-term stagnation. Wages barely moved. Consumer spending weakened. Young people became increasingly pessimistic. An entire generation grew up with the assumption that life would not improve economically. And this psychological shift may actually be one of the most important parts of the entire story. Because once people stop believing tomorrow will be richer than today, economies begin behaving very differently. Consumers spend less. Companies invest less. Workers avoid risk. Everything becomes more conservative. And Japan slowly transformed into an economy obsessed not with growth, but with stability. Then came the demographic crisis. Japan's birth rate collapsed. Young people delayed marriage. Housing became expensive. Work culture became exhausting. Economic uncertainty lingered. And over time, fewer and fewer Japanese citizens chose to have children. Today, Japan has one of the oldest populations on Earth. Nearly 30% of the country is over the age of 65. That changes everything. Healthcare costs rise. Pension burdens increase. The workforce shrinks. Consumption slows. Entire rural towns are disappearing. Schools are closing. Abandoned homes are spreading across parts of the country. Japan is not just aging, it is literally shrinking. And in most economic models, that should create enormous instability. Because modern economies are built around one core assumption: tomorrow will contain more people, more workers, more consumers, and more growth than today. Japan broke that assumption. But instead of collapsing, it adapted. Quietly, slowly, sometimes painfully. And much of that adaptation centered around one institution: the Bank of Japan. The Bank of Japan may be the single most important reason the Japanese economy never collapsed. Over the past 3 decades, the BOJ has effectively run one of the largest economic experiments in modern history. When growth slowed, it cut interest rates. Then it cut them again and again. Eventually, Japan became the first major economy to experiment with near-zero interest rates permanently. Then came quantitative easing. The central bank began purchasing government bonds at enormous scale. Then it bought exchange-traded funds. Then corporate assets. At one point, the Bank of Japan became one of the largest shareholders in the Japanese stock market. Think about how extraordinary that is. The central bank itself became one of the largest owners of private assets in the entire economy. Why? Because the BOJ realized something terrifying. The Japanese system had become too dependent on cheap money to survive without it. Raising rates significantly could trigger debt crises, bank failures, asset crashes, government financing problems. So instead, the BOJ effectively trapped itself. It kept interest rates extremely low for years, and this created a strange side effect. Japan's debt stopped behaving like normal debt. Normally, when countries accumulate massive debt, investors begin demanding higher interest rates. That makes borrowing more expensive. Debt spirals worsen. Eventually, governments face crisis. That happened in Greece. It happened in Argentina. It has happened throughout history repeatedly. But Japan is different. Because most Japanese government debt is held domestically, Japanese institutions own it. Japanese pension funds own it. Japanese banks own it. And increasingly, the Bank of Japan itself owns it. This matters enormously. Japan is not heavily dependent on foreign lenders the way many indebted countries are. And because the BOJ controls interest rates so aggressively, the government can continue financing massive debt loads at relatively low cost. In other words, Japan effectively created a closed financial ecosystem where the government, banks, pension system, and central bank all became deeply interconnected. That system looks stable on the surface, but it also creates fragility, because now the entire structure depends on confidence continuing indefinitely. And this is where things become truly unsettling, because many other countries are slowly moving in the same direction. For years, Japan's ultra-low interest rates created another side effect. The yen weakened. Investors could borrow cheaply in Japan and invest elsewhere for higher returns. This became known as the carry trade. As money flowed outward, the yen gradually lost strength. Now at first, a weaker yen actually helped Japan. Exports became more competitive. Tourism surged. Foreign visitors flooded into Tokyo, Kyoto, and Osaka. But eventually, the weakness became dangerous. Japan imports much of its energy and raw materials. When the yen falls too far, imports become expensive. That creates inflation. And inflation is particularly painful in a country where wages barely grew for decades. Suddenly, Japan found itself trapped again. Raise rates too quickly, and debt becomes dangerous. Keep rates too low, and the yen weakens further. There are no easy exits. And that is perhaps the defining feature of modern Japan. Not collapse, not recovery, but permanent management. The entire economy increasingly functions as a balancing act designed to avoid instability. Now, if Japan were any other country, this system might have broken long ago. But Japan possesses something economists often struggle to quantify: social cohesion. Japanese society places enormous value on order, duty, and collective responsibility. People save more. Communities remain stable. Crime stays low. Social trust remains high. Even during economic stagnation, Japan largely avoided the kind of political chaos many Western economies now experience. There were no major populist revolutions, no dramatic societal breakdown. Instead, the country adapted slowly. Pain was absorbed quietly. Young people accepted lower expectations. Companies prioritized employment stability over efficiency. Workers tolerated stagnant wages in exchange for security. That trade-off is difficult for many Western economies to replicate. because Japan's system relies heavily on cultural stability and institutional trust. And yet, even Japan is beginning to strain under the pressure. Its workforce is shrinking too quickly. Its productivity challenges remain. Its rural regions continue hollowing out. And perhaps most importantly, its model depends on a world that may no longer exist. For decades, economists treated Japan as an anomaly, a strange, isolated case. But slowly, the rest of the developed world started developing similar symptoms. Europe is aging. South Korea's birth rate has collapsed. China's population is now shrinking. Even the United States is experiencing slower productivity growth, higher debt burdens, housing affordability crises, and rising dependence on central bank intervention. Governments everywhere borrowed heavily after the 2008 financial crisis, then borrowed even more during the pandemic. Central banks suppressed interest rates for years. Asset prices surged. Housing became increasingly disconnected from wages. Sound familiar? The similarities to Japan are becoming difficult to ignore. And perhaps the most important lesson from Japan is this. Modern economies may not collapse dramatically. They may simply slow down. Stagnation can last far longer than most people expect. Debt can accumulate for decades. Central banks can keep systems functioning much longer than traditional theory predicts. The future may not look like explosive crisis. It may look like permanent low growth. Aging populations, weak productivity, and economies increasingly dependent on monetary intervention just to maintain stability. In other words, Japan may not be the exception. It may be the preview. And this brings us to the truly uncomfortable realization. The scariest thing about Japan is not that it collapsed. It's that it didn't. Because collapse would at least imply resolution. Instead, Japan demonstrated that advanced economies can continue functioning for decades even while many of their underlying structural problems quietly worsen. Governments can borrow endlessly. Central banks can suppress instability. Societies can normalize stagnation. People adapt, and slowly expectations shrink. The dream of rapid growth disappears. The idea that each generation will live dramatically better than the previous one begins fading away, not through catastrophe, but through gradual adjustment. And that may ultimately be the future many developed nations are drifting toward. A world where economies become increasingly stable on the surface, but increasingly dependent on intervention underneath. Where debt never truly gets solved. Where demographics never fully recover. Where growth remains permanently weak. And where central banks quietly become the pillars holding everything together. Japan spent decades being treated as a warning. But history may eventually remember it differently, not as the country that failed, but as the first country forced to confront the economic realities of a world with aging populations, slowing growth, and limits to endless expansion. Because the truth is, Japan may not be dying. It may simply be living in the future before everyone else. And if that's true, the question is no longer why Japan still hasn't collapsed. The question is whether the rest of the world is prepared for what comes next. Thanks for watching.